Nvidia getting a boost here from the street today after losing its only remaining sell rating. HSBC giving the chipmaker a double upgrade to buy, raising its price target from 175 to 355 on Nvidia's AI potential. The chipmaker climbing by just over 2% today. Year to date, though, we're looking at gains of nearly 90%. Joining us now is Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. It's great to see you here so clearly. Nvidia, lots of upside potential. At least HSBC thinks in terms of the AI and investment there. What's your current view on Nvidia and the run-up that we've already seen year to date?
So the way I look at this call today, you hit the nail on the head. This is the last analyst capitulating who had to sell. And what happens with reported sell-side research is when the stock runs, they have to change their calls or else they look awfully bad. So I don't know if anything was incrementally revealed today. I think Nvidia will be one of the leaders in a basket of AI stocks, though right now I think the stock is a little expensive. And maybe even more than a little expensive, could be even a lot expensive. I own the stock, but it's not one of my big holdings, not because I have a fundamental issue with it. I think it's going to be just fine. I just think after up 90% nearly year to date, it may be ahead of itself. Let's hear what they say in their next conference call about their outlook. I hope it doesn't disappoint.
Yeah, really hard to imagine more room to run after the year they've had. How has artificial intelligence essentially remade the entire sector from an investor perspective?
Well, particularly with the semiconductor names, we're all coalescing around who are going to drive these chips. Now, the nice thing about these AI chips is that they will come with much higher price points and much higher profitability. So maybe some of the move in Nvidia is justified. There will be some other players too. I think Advanced Micro Devices, AMD, will be a player in the space. The problem with that particular company is, at least in the near term, it's diluted by pretty poor fundamentals in the global PC business. But there will be more, but Nvidia will probably be the leader specifically in the AI segment.
Paul, how much of, is the worst of the rout that we certainly did see in the chip makers the last year? Nvidia was one of those names under a tremendous amount of pressure up until around the fall, October. Is the worst of that behind us? And what does the runway of growth look like for a number of these names?
I think the semiconductor companies should have a better second half. The only question is, how much is that already baked into their stock prices? A lot of PC companies have done poorly. The smartphone industry has been in decline. And even though the bulk of the semiconductor industry has moved away from those two end markets over time, they still have at least some of dependence. And so the coast will not be clear until we get a resurgence in both smartphone unit demand and PC unit demand. AI is great. It'll be a big deal over time. But right now, there are some other areas that we have to worry about. That's why I think some of these stocks, particularly the ones that have just cascaded upwards since last fall when they troughed in October, may, if they don't deliver outstanding fundamentals like huge meet and beat numbers the next couple of quarters, people will say, wow, that stock's kind of expensive. I can't buy it here. Maybe I should even sell it.
Paul, how are some of these chip names and perhaps other names in the tech space benefiting from a perception that the Fed will pause, if not cut rates later this year?
That's my greatest concern. I think right now it's the 80-20 rule, not just in semiconductors, but in technology. In the first quarter of 2023, the NASDAQ is up 17%, which is a great year in a single quarter. And the more value-centric Dow is flat. And I don't think it is because tech companies have necessarily distinguished themselves. The biggest story so far in tech this year has been how many people you can fire and cost cutting. What has driven these stocks, and almost solely has driven these stocks, is the perception that not only the Fed stops raising rates, which I think is accurate, but turns around and pivots and starts lowering them. I don't think that part's going to happen. And if that doesn't happen until deep into next year, which is my forecast, you might have some comeuppance in these stocks, particularly the tech names and other aggressive growth names that are totally being propelled by the view that the discount rate will go lower, which is the Fed will start to pivot and lower rates. Don't think it's going to happen.
A reckoning could be on the horizon. Paul Meeks enjoyed the conversation. Thank you, sir.